I wanted to start with a note that you actually put out a number of weeks ago. And the title was something like, why are we so happy with 8.5% CPI? Savita, why was this market so happy with 8.5% CPI?
Look, I think that part of it was the idea that we're off peak. But our point was, sometimes the second derivative doesn't matter. Sometimes it's the first derivative you want to pay attention to. And 8.5% CPI is really far away from 2 or 3%, which is what we believe the market is pricing in. I think that, when I hear the bullish arguments for, kind of justification for the rally that we've seen from July, or, from June, I guess, it's two things. It's one, we've moved past peak inflation, but wages are still strong, so the consumer is still going to be okay, therefore soft landing. That's one bullish argument that I disagree with. And the second bullish argument that I disagree with is that we've seen earnings better than feared. We've seen results better than feared, and everybody points to really strong top line and 15% sales growth for the S&P. The problem with that is that most of the work for sales was coming from energy. Energy grew sales by 80%. Everything else was fairly lackluster. And then when you adjust for inflation, when you take that 9% print of inflation out of 2Q sales, the sales for the S&P 500 ex energy were essentially flat. More companies in the S&P 500 undershot inflation in sales, couldn't grow sales faster than pricing, which is really, kind of a weird setup versus the other half that managed to beat CPI. So I think that what we're all looking for are reasons to get more bullish, but the reasons are pretty thin, if you ask me. On peak CPI and still strong job costs, I see that as still strong labor. I see that as overwhelmingly negative, because what that means is pricing power for the average corporation is starting to wane, demand is starting to wane, but wages, which are the biggest depressant on corporate margins for the S&P 500, are sticky and high. Why are we celebrating about this? I just don't get it.
And that was the essence of your note, Savita. We caught up with Mike Wilson of Morgan Stanley yesterday, who's very much on the same page as you at the moment on some of these issues. Take a listen to what he had to say.
The whole fire and ice narrative is coming back into play. We're in a downtrend. And until the market can get back above that downtrend, I think to be making some grandiose call about new highs is quite frankly, it's irresponsible given what's going on with the Fed and QT coming, as Bob laid out. It's going to be a lot worse than people have experienced so far. Price is wrong and the earnings are wrong again, which means the attractiveness, the risk reward today could be almost as bad as it was back in January.
Savita, you're back at 3,600 on the S&P 500. That's your forecast. What's the Fed's role in that move lower that you're looking for?
Look, I don't think the short end of the curve and what the Fed's doing at the short end matter as much as the long end. And I think that what's bizarre to me is that, I think this laser focus on, sort of inflation prints and on a monthly basis and real-time reads on inflation. And what is the Fed going to do? Are they going to hike 50 basis points or 25? Are they going to start cutting? I think all of that is second to what happens at the long end of the curve. And, I like that phrase, complexity of the moment, because I think this is a very complex moment for equities. And the reason I say that is the duration of the S&P 500 is still above 30 years. We're looking at a 30-year zero coupon bond. So what that means is that a mere 50 basis point change in the cost of equity capital, which is more influenced by the long end, could drive the market either really high or really low from here. Right. And I think that's what makes up the complexity of the moment for equities.
Savita, Brian Moynihan takes immense pride in studying the granularity of American business. It is the franchise of your Bank of America. What are you and the sell side at Bank of America, the research analysts, what are they saying about how corporations are adapting and adjusting to these complexities?
Well, you're right. So corporations are adapting and adjusting, and it's really marvelous to watch. But I think that what that requires is a fair amount of capital spending from the big multinationals that are in the process of rejiggering supply chain, which is a complicated and long process that costs a lot of money. They're also in the process of automating labor, which has gotten that much more expensive. So this is all really good for long-term productivity of corporations. We haven't seen a real CapEx cycle in a long time because earnings have been buoyed by low rates, buybacks, all sorts of machinations that aren't real economic growth. But I think what we're seeing now is the beginnings of a real growth cycle driven by companies getting more productive. And that is very bullish for the S&P 500. Unfortunately, I think it takes a little while to get there, and it also costs a lot in terms of capital spending. So what we like within the market are the more domestic plays that could benefit from that CapEx cycle. And Jill Hall, our SMID strategist, has been talking about this, on your show quite a bit. So I think that's a great area to start to deploy capital. But multinationals, for the time being, yeah. I mean, I think multinationals.
Well, it's bullish talk. It's bullish talk from Savita.
Well, hold on a second, Savita. This is actually exactly where I wanted to go, because basically everyone's calling me a bear and dressing me up as one on the internet. But I am wondering, from your perspective.
Who's doing that to you?
Well, there was a bear head.
Like a meme thing.
Yeah.
Like
which is okay. I accept it. I embrace it.
That happens to me
I'm not
before
scared
as well.
of it.
Yes.
I will just say, though, there is this sort of bullish tilt. There is no. I embrace it. But if what is the after 3,600, right? This is the distinction between the long-term bulls and the long-term bears, right? 3,600, is that the new low that is catharsis that then leads to adjusting and adapting of Tom Keene? Or is this a more protracted loss in the momentum and, frankly, the valuation of U.S. equities?
Look, I think this is all happening at a warp speed. So at the beginning of the year, our long-term model was pointing to negative returns for the next 10 years. Today, the good news is that after this massive drop in the market and lower, not low, but lower multiples, that model is spitting out, mid-single-digit returns for the S&P 500 for the next 10 years. That's a much better setup, a much better entry point. I do think that point-in-time targets are fraught with all sorts of problems. But I will tell you this. I think that the fact that just a mere 50 basis point change in the cost of equity capital, either long rates or the risk premium, could drive us to our target of 3,600 makes me worried about the downside risk.
Savita, I got a key question. It's for all of Global Wall Street. They know you own the high ground on ESG investing. Essentially, you invented it. Is ESG investing dead? Where is it in a year? I'm serious. Where is it in a year?
Well, I think what the problem right now is that investors are throwing the baby out with the bathwater. And we've done a lot of great work on, and we've talked about our work on your show. ESG investing is nuanced. It's not one size fits all. Different sectors have different factors that are more important for driving. Social factors are more important for labor-intensive innovators. Environmental factors are more important for energy and materials. So it's not just some kind of, one size fits all, apply this rating to your entire portfolio and you're done. But we do think that there are a lot of ESG considerations that are being ignored in this, kind of refusal to even think about ESG in an environment where it's drawing a lot of fire. So I think it's a complex, nuanced topic, but I still think that there are lots of ways to make money.